Retail REITs just flipped the script in 2025. And the winners aren't the giant names everyone crowds into, but the smaller focused players that move fast and price smart. If the portfolio still leans heavy into big retail REITs for safety, this is the wake-up call to rethink returns, yields, and rate cycle timing before the window narrows. This video breaks down why smaller retail REITs are beating the behemoths, how to read the signals, and the practical way to pivot without blowing up risk controls. Quick cred check so new friends know who's talking. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. The channel just crossed 1 million reads and 58,000 likes. There are over 1,000 videos with more than 600,000 watch hours as of August 2025. And the coverage focuses on regional and global macro trends that move SG portfolios. This episode is adapted from the latest Substack deep dive. Same structure, more storytelling, so expect a clear roadmap that mirrors the article. The big REIT reversal, the small cap edge, the dividend sweet spot, asset quality versus scale, risk trade-offs, the rate turn play, a portfolio blueprint, and then a grounded bottom line for SG investors. Picture a Saturday crowd at a Heartland mall, families, groceries, packed F&B lines, and sales tags everywhere. This isn't vibes, it's policy and recovery flow-through, meeting real demand on the ground. Singapore's growth is penciled around 3% for 2025, and consumer support like CDC and SG60 vouchers has kept tills ringing, which supports tenant sales and rent conversations in suburban-heavy portfolios. Occupancy tells the truth. Top retail landlords are above 96%, with standouts like FCT near full house at 99.9%, and rental reversions have shifted back to landlords with mid-single digits to low teens uplift on renewals where assets are prime or well-curated. With rate cuts expected from September 2025, financing headwinds fade. Smaller REITs often feel the relief faster due to shorter maturities and more immediate refinancing touches, which flows straight into distributable income momentum. A quick snapshot to anchor the field. CICT sits at about 17.5 B by market cap with 44.7% yield and 99.6% YTD, while smaller peers like StarHill Global print 6.8% yield with 20.2% YT, and Lendlease Global shows 6-month yield with 10% YT as of September 25, with FCT in the middle lane on yield and occupancy excellence. What to screenshot from the Substack table? Size does not equal outperformance. The smaller cohort is delivering meaningfully higher total returns without giving up income. And that's the shakeup most missed in H1Q3 2025. Pause here following along on the article. This is the first aha moment to share with any friends still equating market cap with safety and returns. Let's frame this like a manager versus operator story. Big operators manage breadth. Small operators master depth. Fast action on leases, sharper AEIs, tighter marketing, and more surgical tenant mix work, property by property. Lendlease Global's playbook is a tight set of premium assets like GEM and 313 at Somerset with double-digit rental reversions. Intensive asset management that is hard to scale across 20-plus properties without losing edge. StarHill Global spreads its footprint, mixing orchard exposure with overseas assets, which adds diversification across tourism cycles and currencies. Helpful when orchard ramps on travel, yet offshore legs add ballast when SG slows. On valuation, the market still prices smaller names cheaper. StarHill Global's PE around 11.3 versus CICT at 17.1 signals a bigger margin of safety if operations keep improving, which 2025 metrics suggest is happening across rent and occupancy. Here's the describe the table moment from the Substack. A simple grid showing CICT and FCT at higher PEs with sturdy balance sheets, while StarHill, Global, and Lendlease carry slightly higher gearing, but pair it with stronger rental reversion and more attractive headline multiples, prime ingredients for total return in a soft landing, easing rates year. Ask this aloud. If the yield is higher, reversions are firm, and leverage is manageable, why is the small cap premium still there? That gap is where alpha lives. until the market reprices or a stumble tests the thesis. Income fans, this is where eyes light up. StarHill Global near 6.8% and Lendlease Global near 6.5% are compelling against CICT's over 4.7%, with FCT offering a balanced 5.3% plus almost perfect occupancy for sleep well stability. The key question: are these yield traps? The answer hinges on rental reversions and occupancy trends, which in 2025 are positive across the board for the quality retail names, even if Lendlease's recent DPU growth dipped due to timing and capital actions that set up future lift as lower rate refinancing and releasing flow through. The Substack's dividend table makes it easy. Lendlease shows negative DPU growth near term, note that, yet pairs it with strong pricing power on renewals. Meanwhile, FCT's occupancy is a masterclass in necessity retail resilience, and StarHill sits in a rare sweet spot of higher yield with stable occupancy. A quick narrative recap for memory. Higher yields are available in smaller names, supported by rising rent tags and solid occupancy, with one caveat that some names may show near-term DPU softness, even as the ingredients for a 2026 recovery build under the hood. That's not a contradiction, just timing versus trajectory, and it matters if the strategy is 2 to 3 years, not 2 to 3 months. Post-pandemic, retail value creation moved from spread out, more is more, to curated less, but better. Lendlease's 4-asset focus lets management pour attention into AEIs and merchandising, feeding those eye-popping rental reversions at Gem and 300 at Somerset, while Milan Sky Complex give geographic and tenant-type offset to pure SG retail cycles. StarHill blends Orchard Premium with international legs, which means it catches SG tourism while smoothing cyclicality with offshore assets. FCT remains the suburban stalwart, groceries, clinics, enrichment, and F&B that keep footfall sticky, rain or shine. The table takeaway, to describe Live, smaller portfolios with premium placement are punching above their weight on rent uplift, the exact lever that drives sustainable DPU over time. Now the sober part, because returns come with strings. Concentration cuts both ways. When 4 assets sing, it's beautiful. When one hits downtime, the whole portfolio feels it. This is the Lendlease risk to size right. Liquidity is thinner in small caps, so entries and exits can be messy and stress. Execution discipline matters more than usual. Financing flexibility can be tighter with higher gearing and smaller scale, and sponsors vary in strength compared to giants like CapitaLand behind CICT, which brings pipeline and deeper capital access. Picture the Substack's risk table in words. Small equals higher concentration and lower liquidity, but also higher potential growth. Large equals lower concentration risk and stronger sponsor support, but more modest return potential. Choose, then size appropriately. September 2025 looks like an inflection for rates, but the pass-through is not uniform. This is where smaller REITs can front-run benefits due to near-term refinancing stacks and higher gearing torque, translating into faster DPU recovery if rates ease as expected. CICT's laddered profile smooths the benefit over time. Good for stability, slower for step change, so both camps gain, but not equally and not on the same timeline. The core edge now is to position before the market fully discounts these savings into price. The 2025 YTD spread suggests there's still fuel left if rates deliver and operational momentum holds. For all full charts, checklists, and the written playbook, grab this post on Substack. Link in description. Let's turn this into an allocation blueprint mapped to roles, same as in the article, so it's easy to implement and review quarterly. Core holding 40-50% of the REIT slice. CICT for stability, liquidity, and sponsor depth. Anchor the portfolio and let the smaller names swing on top of it. With a passport 4.7% yield and steady DPU growth profile around mid-single digits. Growth engine 30 to 40%. StarHill Global for total return. Higher yield, plus upside from tourism and diversified geographies. This is the small cap bet with better valuation entry and improving operations. Income booster, 10 to 20%. Lendlease Global for yield with rental reversion torque. Keep sizing disciplined due to concentration and recent DPU softness, and monitor refinancing milestones closely as rates turn. Defensive complement, FCT, as a situational ad for recession resistance via suburban necessity, retail, and elite occupancy execution. When narrating the Substack allocation table on screen, highlight 3 ideas. Define each role: core, growth, income. Assign a clear percentage band and list the primary REIT representative. Then add a one-line rationale to internalize why each slot exists in the portfolio. This is not about predicting one winner. It's about engineering robust outcomes across rate cycles and consumer shifts with a simple, repeatable map. Here's the lived lesson after years of watching SG retail cycles. Price power beats portfolio size when the macro shifts from survive to optimize, and 2025 is that shift. In this phase, the smaller premium-placed assets with tight execution capture reversions first and best because leases are touched more actively, marketing is sharper, and AEIs don't get lost in bureaucracy. But never forget how quickly concentration can turn. One asset downtime can undo 2 quarters of gains, so position the upside, lock the core, and keep a cash buffer for volatility in thinner names. The challenge for Singapore investors this quarter: what is the smallest position tweak that captures the small cap upside while keeping sleep quality high? Answer that with a sizing rule and a quarterly review date. Then commit. To recap the journey in the same order as the article, 2025's retail REIT reversal favors smaller, focused players with higher YTD and stronger yields. The small cap edge comes from agility, curated portfolios, and better valuation entry. Income remains attractive and isn't a trap when reversions and occupancy are firm. Quality assets now beat sprawling portfolios. Risk trade-offs exist: concentration, liquidity, sponsor depth, and must be sized right. Rate cuts should hit smaller names faster, and a balanced portfolio uses CICT as the core, StarHill as growth, Lend-Lease as income torque, and FCT as defense. If this helps sharpen a plan, like the video, share it with an investor friend, and subscribe for more SG-focused breakdowns every week. Members get early access, watch lists, and allocation checklists. So join the membership to support deep dive research and get the tools to act with confidence. For continuity, the next recommended video is REITs versus T-bills in a rate cut cycle: when to switch gears, which pairs well with today's rate timing discussion and income strategy. And for full tables, visuals, and checklists, the Substack post is linked below. Bookmark it and use it as a quarterly review template.